Hello everyone, and welcome to this lesson on a crucial but often overlooked aspect of trading, intermarket analysis. Today, we're going to move beyond looking at single assets and learn how the major asset classes, bonds, equities, commodities, and currencies, move together, and sometimes, move against each other. Understanding these relationships can give you a significant edge. So, what exactly is intermarket analysis? Simply put, it's a branch of technical and fundamental analysis that examines the relationships between different asset classes. How do stocks influence bonds? How do commodities affect currencies? This approach was largely popularized by the work of John J. Murphy. The ultimate purpose is to help us identify potential turning points in the market, confirm trends we're seeing in one asset, and improve our timing by seeing the bigger picture. You might be wondering, why should I care? The answer is that no market exists in a vacuum. A sharp move in the bond market can be a powerful foreshadowing of a move in equities. These correlations are fantastic at signaling the broader market mood, what we call risk-on or risk-off environments. This knowledge is invaluable for diversification, for hedging your portfolio, and for spotting critical divergences. But a key warning, these relationships are not set in stone. They are dynamic and can change over time. Let's meet our four main players. First, bonds. They reflect interest rates and inflation expectations. Then, equities, or stocks, which are a barometer for risk appetite and economic growth. Next, commodities, which signal inflation and global demand. And finally, currencies, or FX, which reflect global capital flows and differences in interest rates between countries. A classic chain reaction is, rising commodities lead to higher yields, which in turn leads to weaker bond prices, as inflation expectations heat up. Now, let's look at some specific pairs. The relationship between bonds and equities is foundational. Historically, they've had a negative correlation. When bond prices go up, stocks go down, and vice versa, especially in a low inflation, low rate environment. Why? Because rising yields mean higher borrowing costs for companies, which can hurt corporate profits and equity prices. Crucially, the bond market often moves before the stock market, so watching treasury yields can give you an early warning signal. Next, equities and commodities. Commodities are often a leading indicator for the economy. Rising commodity prices can signal strong global growth, which is good for stocks. But there's a double-edged sword here. If commodity prices, like oil, rise too high, it can squeeze company profit margins and act as a tax on consumers, eventually becoming a headwind for equities. Watching an index like the CRB index against the S&P 500 can provide great clues. One of the most direct relationships is between commodities and certain currencies. These are the so-called commodity currencies. The Canadian dollar, or CAD, is heavily linked to oil. The Australian dollar, or AUD, is tied to metals. And the New Zealand dollar, or NZD, is influenced by agricultural prices. When these commodities rise, it boosts the economies of these exporting nations, strengthening their currencies. So, if you're trading the CAD, you absolutely must have one eye on the oil market. The link between FX and bonds is all about interest rate differentials. Currencies tend to flow towards the country offering higher yields. If interest rates or bond yields are rising in the United States compared to Europe, international capital is attracted to those higher returns, which strengthens the US dollar. So, for FX traders, tracking central bank policy and long-term government bond yields is a fundamental part of the job. Now, let's try to put all of this together. There's a typical cycle and a set of relationships you can see summarized on this slide. For instance, bond yields and equities often have an inverse relationship. Rising commodities and equities are often positively correlated in a growth environment. A strong US dollar is often negative for commodities, as they are priced in USD. And rising yields in a country typically strengthen its currency. But remember, the most important note here is that these relationships shift depending on the economic regime, whether we're in an expansion, a contraction, or a stagflationary period. So, how do you use this? Here are some final tips and risks. For tips, use intermarket analysis for confirmation. If your stock chart says buy, check that the bond market isn't flashing a warning sign. Always monitor for changes in these correlations and for divergences, they can be powerful signals. As for risks, the biggest one is assuming these correlations are permanent. They can undo, weaken, break down, or even reverse. Always be aware of the broader economic regime. The key takeaway is this: intermarket analysis provides a macro, top-down edge that pure price chart analysis might miss. It doesn't replace technical or fundamental analysis, it complements them, making your overall market view much stronger. Thank you for your time. I encourage you to start watching these relationships in the live markets. It will completely change how you see price action. Happy trading!